chaos erupted on Wall Street at 9:32 a.m. Not because the market was crashing, but because it was soaring. Trillions in paper wealth appeared out of nowhere while factory layoffs hit a 10-year high. The US just recorded its weakest growth since the pandemic, yet the S&P roared past every record ever set. How? Because the money fueling this boom isn't coming from profit. It's coming from debt. From central banks printing confidence faster than the economy can earn it. The charts say boom, the streets say bust, and somewhere between those two lies the greatest financial illusion of our time. In early 2025, the U.S. stock market S&P 500 hit an all-time record above 5,700 points, even as the Conference Board's leading economic index fell for the 20th consecutive month, a signal historically tied to recession. According to Bloomberg data from April 2025, GDP growth for the first quarter slowed to 0.6% annualized, while equity valuations soared as if prosperity were accelerating. The divergence has never been wider. Nvidia's market capitalization, as reported by Reuters in August 2025, surpassed $4.4 trillion, greater than Japan's entire yearly output. A company selling microchips is now worth more than nations that build cars, cities, and ships. The illusion is not the number itself, but what it represents, a market unanchored from production. The Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia, control over 33% of the S&P 500's total value, based on FT index data from July 2025. That concentration means the rise of a handful masks the stagnation of thousands. Beneath the surface, nearly 60% of listed U.S. firms trade below their 2022 highs. The index climbs, but participation collapses. Wall Street rationalizes it as efficiency, but the underlying economy tells a different story. The Bureau of Labor Statistics reported in May 2025 that real hourly earnings declined 1.1% year over year, adjusted for inflation. Simultaneously, corporate profits before tax hit $3.8 trillion, a post-pandemic record. Workers earn less, assets earn more. The foundation was laid long before. After 2008, central banks deployed quantitative easing, expanding global balance sheets to over $32 trillion by 2024, according to IMF data. Liquidity became oxygen. Interest rates near zero incentivized corporations to borrow cheaply, not for innovation, but for self-enrichment. S&P Global calculates that from 2010 to 2024, U.S. companies spent $10.2 trillion on share buybacks, more than on research and development. This flood of money produced the Cantillon effect in real time. Those closest to the money printer, banks, hedge funds, and asset managers, captured gains before prices adjusted. The Federal Reserve's own survey of consumer finances showed the top 10% now hold 89% of all U.S. equities. Wealth became a byproduct of proximity, not productivity. When inflation returned in 2022, policymakers misread it as transitory. By 2025, consumer prices had cooled to 3.1%, but asset prices had doubled since 2020. The illusion of prosperity persisted because the metrics themselves became distorted. An economy struggling with stagnant real demand could still produce a euphoric stock chart. Credit markets tell a subtler story. Corporate debt as a share of GDP reached 75%, according to the IMF Quarterly Monitor in 2025, which is the highest in history. Refinancing risk mounts as average yields on investment-grade bonds climb above 5%, levels unseen since 2007. When the cost of borrowing exceeds expected returns, the math collapses. Yet investor behavior defies gravity. Bank of America's August 2025 fund manager survey found 91% of global portfolio managers considered U.S. equities overvalued, but 83% remained overweight. The logic is mechanical. When cash yields 2% and stocks yield nothing, yet promise momentum, fear of missing out overrides prudence. Monetary policy turned markets into Pavlovian systems. Every dip assumes rescue. In June 2025, the Fed briefly paused its tightening cycle. Within hours, the Nasdaq jumped 4%. Traders now interpret central bank restraint as a buy signal rather than a warning. The institution meant to prevent excess has become its guarantor. Beneath that euphoria lies erosion. The U.S. Census Bureau reported retail sales growth slowing to 2.1% year-on-year, while credit card delinquencies reached a 10-year high at 3.6%. Household balance sheets weaken even as indexes rise. The divergence is not accidental, it's structural. Housing, the traditional barometer of middle-class stability, has decoupled from wages. According to the National Association of Realtors, the median home price hit $431,000 in 2025, while median household income hovered near $76,000. Mortgage rates above 7% push ownership further away. Institutional landlords, funded by cheap credit, fill the void. The psychological effect is corrosive. As the Financial Times observed in May 2025, retail investor participation in direct stock ownership fell to its lowest since 2016. People watch markets rise, yet honestly, they feel poorer. That paradox undermines faith in capitalism's fairness, and, well, even in data itself. Historically, equities mirrored productivity. Today, though, they mirror liquidity. In 2024 alone, central banks added $6.3 trillion in global asset purchases, despite pledges to tighten, according to the IMF Monetary Survey. Such injections, they perpetuate valuation inflation that's really detached from growth. The system just cannot tolerate withdrawal, which is why each attempt at normalization ends in renewed easing. Corporate leadership exploits this dependence. A Financial Times investigation into S&P 500 balance sheets found more than 40% of listed companies use debt for share repurchases exceeding 30% of annual cash flow. The illusion of earnings per share, honestly, hides deteriorating fundamentals. Even credible growth stories, well, they rest on fragile assumptions. Tesla trades at over 70 times forward earnings, according to WSJ Markets in September 2025, despite flat vehicle deliveries and shrinking margins. Meta's share price recovered 140% since 2023 on cost cutting, not user growth. Valuation has become belief, not projection. Meanwhile, government debt compounds the illusion. The United States Treasury's outstanding obligations surpassed $36 trillion in 2025, more than 130% of GDP. Interest payments alone consumed $1.2 trillion this fiscal year, according to the Congressional Budget Office. Markets celebrate stimulus, but each dollar of new spending erodes confidence in repayment. Global capital reacts accordingly. The IMF's World Economic Outlook noted a $480 billion shift of reserve assets into gold and non-dollar currencies in 2025. Central banks from China to Brazil diversify away from treasuries, signaling diminishing trust in American stability. Even the labor market's apparent resilience hides fragility. The unemployment rate remains near 4%, but labor force participation stagnates at 62%, with record part-time employment and gig work distorting statistics. Real productivity per worker has declined 0.8% annually since 2021, according to BLS data. The headline strength is an illusion of measurement. Investors cling to technology as salvation. AI, automation, and cloud computing fuel optimism, yet productivity data show no equivalent payoff. The Bureau of Economic Analysis recorded non-farm productivity rising just 0.3% in 2024. The promise of future efficiency replaces the reality of present stagnation. When expectations exceed performance, volatility becomes inevitable. The VIX index, Wall Street's so-called fear gauge, jumped 40% in late September after a single disappointing inflation print. Markets that require perfection to sustain valuations just can't survive mediocrity. Meanwhile, energy and commodity data reveal deeper strain. Brent crude averaged $70 a barrel through summer 2025, according to Reuters Commodities. High input costs eat into corporate margins, forcing price increases that rekindle inflationary pressures. Precisely what central banks fear most. Internationally, signs of stress multiply. The Eurozone's composite PMI fell below 50 for 4 consecutive months, signaling contraction. Japan's industrial production dropped 2.4% quarter over quarter. Even China's retail spending decelerated to 3% growth, its weakest post-pandemic reading. Global slowdown contrasts sharply with Wall Street's euphoria. Debt leverage magnifies every swing. Margin debt on U.S. exchanges reached $980 billion in 2025, according to FINRA reports. When valuations wobble, forced liquidation accelerates declines, turning minor corrections into crises. Market confidence has become reflexive. Prices rise because they rose yesterday. As Yale economist Robert Shiller told Bloomberg in June 2025, it's not optimism, it's inertia. Investors extrapolate history, ignoring fragility. The Federal Reserve faces a trap. Raise rates further and asset bubbles burst. Cut them and inflation resurfaces. Chair Jerome Powell admitted in a press conference that policy transmission may be uneven, a diplomatic phrase for loss of control. Monetary credibility, once unquestioned, now depends on perception rather than outcome. Political pressure compounds the risk. With elections approaching, fiscal spending accelerates despite deficits. Government stimulus sustains consumption temporarily, but markets treat it as perpetual. The feedback loop is psychological as much as financial. What happens when that confidence fractures? In every past cycle, 1929, 2000, 2008, the catalyst was not data, but belief breaking. Today, belief itself is the asset class. Let's pause, because this wasn't supposed to happen. Markets were designed to price future earnings. Now they price faith in central banks. That inversion rewires capitalism's logic. Liquidity became the new productivity. The more money printed, the higher valuations climb, until growth becomes irrelevant. Yet history records no instance where liquidity alone sustained value indefinitely. When Bloomberg modeled U.S. equity returns versus Federal Reserve balance sheet growth over 2 decades, correlation exceeded 0.9. The market statistically moves with policy, not profit. Remove the liquidity, remove the miracle. Even the IMF now warns of asset valuation excesses posing systemic risks. Translation: central banks know the illusion exists, and may not know how to unwind it. Meanwhile, the social consequences deepen. Pew Research in 2025 found 70% of Americans believe the economic system favors the wealthy. Confidence in financial fairness hits record lows. Economic fragility morphs into political volatility. In that environment, volatility itself becomes policy. Each correction prompts intervention. Each intervention inflates the next bubble. Markets lose their natural cycle, a perpetual motion machine powered by fear of collapse. At some point, equilibrium demands reversion. Whether triggered by a credit default, a rate shock, or an external geopolitical rupture, the system must reconcile numbers with reality. No one knows the timing, only that the arithmetic no longer adds up. And when it does, the collapse may not look like 2008. It could unfold quietly, liquidity drying, valuations melting, faith evaporating. A slow-motion reversal of the illusion built over decades. Because markets can defy fundamentals longer than anyone expects, until they can't. And when that moment arrives, the question will not be why the market fell. It will be how anyone ever believed it was real. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.